The United States dollar has long held a special place. It is the world's primary reserve currency. This status was largely cemented after World War II. The Bretton Woods Agreement in 1944 was pivotal. It pegged other major currencies to the dollar. The dollar itself was convertible to gold. This system established a framework for global finance. It brought stability to international trade for decades. Nations held dollars in their central banks as reserves. This made international transactions smoother and more predictable. The dollar's dominance extended beyond official reserves. It became the currency of choice for many global transactions. Oil, a vital commodity, has been priced in dollars for many years. This is often called the petrodollar system. This further entrenched the dollar's role in the global economy. Businesses around the world used dollars for import and export. It simplified international commerce. The liquidity and perceived safety of the dollar were key attractions. This widespread use created a deep and robust market for the currency. This system, however, was not without its implications. The strong global demand for dollars gave the United States considerable economic leverage. It could finance its deficits more easily. U.S. monetary policy had far-reaching effects on other economies. For other countries, holding large dollar reserves meant being tied to U.S. economic conditions. This dependence was a source of stability, but it also created vulnerabilities for many nations. The global financial system became very dollar-centric. Recently, questions about this long-standing arrangement have grown louder. The global economic landscape is changing. New economic powers are emerging. Geopolitical shifts are also influencing financial thinking. The idea of a single currency dominating global trade is being re-examined. Many countries are beginning to explore alternatives. They seek to reduce their reliance on the dollar. This marks a potentially significant turning point. The future of global finance could look very different from its past. The term de-dollarization is heard more frequently now. It refers to a deliberate effort by countries. They aim to reduce their dependence on the US dollar. This is not a sudden phenomenon. It has been a gradual development. Several factors contribute to this growing trend. Geopolitical considerations are a major driver. Countries may wish to reduce their vulnerability. They want to be less susceptible to U.S. foreign policy. This includes the impact of potential sanctions. Economic reasons also underpin the de-dollarization movement. Fluctuations in the dollar's value can impact other economies. A strong dollar can make imports more expensive. It can also increase the burden of dollar-denominated debt. Countries desire greater control over their own monetary destiny. They seek to insulate their economies from external shocks. The pursuit of financial sovereignty is a powerful motivator. This means having more say in their economic policies. The use of financial sanctions by the United States has accelerated these efforts. When sanctions limit access to the dollar-based system, it highlights risks. Countries become wary of relying too heavily on one nation's currency. This has prompted many to seek alternatives. They want to ensure they can continue to trade. They need to manage their finances even if cut off from dollar networks. Russia, China, and other nations have been vocal about this. They are actively working on creating parallel systems. The ultimate goal for many is a more multipolar currency world. In such a system, several major currencies might share global importance. This could include the euro, the yuan, and perhaps others. Such a shift would represent a fundamental change. It would alter the balance of global economic power. The implications would be far-reaching. It would affect international trade, investment, and financial stability. The current system, dominated by the dollar, faces a clear challenge. China is a key player in the de-dollarization narrative. It has been systematically working to elevate its currency. The Chinese yuan, also known as the renminbi, is central to this strategy. China's economic influence has grown immensely. It is now the world's second-largest economy. It is also the largest trading nation. Beijing believes its currency should reflect this global standing. Promoting the yuan internationally is a long-term strategic goal for the country. One major initiative supporting this is the Belt and Road Initiative, or BRI. This vast infrastructure project spans many countries. China encourages the use of the yuan for BRI-related financing and trade. This gradually increases the yuan's circulation globally. Furthermore, China has established numerous bilateral currency swap agreements. These agreements are made with central banks of other nations. They allow for trade to be conducted directly in yuan and the partner's local currency. This bypasses the need for US dollar conversion. The development of a central bank digital currency, or CBDC, is another significant step. China is a front-runner in creating the digital yuan, or ECNY. A digital currency could make cross-border transactions faster and cheaper. It might also offer an alternative to existing payment systems. These systems are often dollar-dominated. The ECNY could facilitate direct international payments. This would further reduce reliance on the dollar. China is testing this technology extensively. China views the internationalization of the yuan as crucial. It is important for its economic security and global influence. A wider use of the yuan would reduce China's own exposure. It would lessen dependence on the dollar for its vast international trade. It would also enhance China's role in global finance. This strategic push is a clear signal. China is preparing for a world where the dollar's role is diminished. It aims to be a leader in the new financial order. Russia has been a prominent advocate for de-dollarization. Its efforts have intensified significantly in recent years. This is largely due to Western sanctions. These sanctions were imposed following geopolitical events. They restricted Russia's access to global financial markets. They also limited its ability to use the US dollar. This situation starkly highlighted the risks. It showed the danger of depending on a currency controlled by another nation. Russia moved decisively to reduce this vulnerability. In response, Russia drastically cut its holdings of US dollars. Its central bank sold off a large portion of its dollar reserves. It increased its investments in gold. It also diversified into other currencies like the euro and the yuan. This was a clear signal of its intent. Russia aimed to protect its economy from US financial pressure. The country has also actively promoted trade in national currencies. This is particularly evident in its dealings with China. A growing share of Sino-Russian trade is now settled in rubles and yuan. Russia has also focused on developing alternative financial infrastructure. It launched its own payment system called MIR. This system processes card payments within Russia. It aims to reduce reliance on Western systems like Visa and MasterCard. Russia is also exploring connections with other countries' payment systems. This is part of a broader strategy. The goal is to create financial networks independent of US oversight. These networks would allow Russia to continue international transactions. These measures are driven by a desire for economic sovereignty. Russia seeks to insulate itself from external pressures. It wants to maintain its ability to trade and manage its finances. The shift away from the dollar is a key component of this strategy. Russia is actively building new economic partnerships. It is looking beyond its traditional Western partners. This pivot towards the East and other regions is reshaping its economic ties. It underscores a commitment to a less dollar-dependent future. Section 5. African Ambitions. The drive for monetary self-reliance. African nations are increasingly joining the conversation on de-dollarization. Many countries on the continent share a desire. They want to reduce their reliance on foreign currencies, particularly the US dollar. This aspiration is driven by several factors. One key motivation is to boost intra-African trade. Trade among African countries has historically been low. Complex currency conversions and reliance on external currencies are partly to blame. Using local currencies could simplify these transactions. Promoting the use of national currencies can strengthen African economies. It can reduce the costs associated with currency exchange. It can also lessen exposure to the volatility of major international currencies. When African businesses trade using dollars, they often face high fees. They also face delays. Direct exchange of local currencies can make trade more efficient. This can also help to develop local financial markets. It encourages greater financial intermediation within the continent. A significant development in this area is the Pan-African Payment and Settlement System, or PAPAS. This platform was launched by the African Export-Import Bank, known as Afreximbank. Its purpose is to facilitate payments for intra-African trade in local currencies. PAPSAS allows a business in one African country to pay a supplier in another. The payment is made in their respective local currencies. This system aims to save the continent billions in transaction costs annually. It directly addresses the challenge of currency convertibility. This move towards greater monetary sovereignty is crucial for Africa. It represents a step towards enhanced economic self-determination. By reducing dependence on the dollar, African nations can have more policy space. They can better manage their economies. They can also become more resilient to global financial shocks. The efforts to promote local currency use are part of a broader vision. This vision is of a more integrated and economically independent Africa. It is a trend that holds significant promise. Section 6. Forging new paths. Tools for a dollarless trade. Countries pursuing de-dollarization employ various mechanisms. These tools are designed to facilitate trade and finance. They aim to do so without relying on the US dollar. Bilateral currency swap agreements are a prominent example. These are agreements between two central banks. They allow the two countries to exchange their national currencies directly. This means businesses can trade using their own money. They do not need to convert to dollars first. This reduces transaction costs and exchange rate risks. Many countries have entered into such swap agreements. China has been particularly active in establishing these lines. Russia, India, Turkey, and others have also pursued this strategy. For instance, India and the United Arab Emirates have an agreement. It allows them to settle trade in Indian rupees and UAE dirhams. This is a practical way to promote local currencies. It gradually erodes the dollar's dominance in bilateral trade flows. These agreements build new financial pathways. Another important development is the rise of central bank digital currencies, also known as CBDCs. Many central banks around the world are exploring CBDCs. Some are even piloting them. These digital forms of national currency could transform cross-border payments. They could offer a more efficient and cheaper alternative. They might bypass the traditional correspondent banking system. This system is heavily reliant on the US dollar. CBDCs could enable direct peer-to-peer transactions across borders. These mechanisms, both old and new, are reshaping global finance. They represent a collective effort. Nations are seeking greater control over their economic interactions. By creating alternative systems, they reduce their vulnerability. They lessen their dependence on a single currency. This is not just about avoiding sanctions, it is about building a more balanced and resilient global financial architecture. The innovation in this space is rapid. The long-term impact could be profound for international commerce. Section 7. Practical shifts, local currencies gaining ground. The shift away from the dollar is not just theoretical. We are seeing practical examples in everyday transactions. These instances show how local currencies are gaining traction. For example, in some regions, international travelers are finding it easier. They can exchange local currencies directly with neighboring countries. Previously, they might have needed to convert their money into US dollars first. Then they would convert it again into the currency of their destination. This simplification benefits ordinary people. In the realm of international trade, changes are also evident. Businesses in BRICS nations, Brazil, Russia, India, China, South Africa, are increasingly using their own currencies. They use them for settling trade among themselves. For instance, reports indicate Indian importers have paid for Russian oil. They used Indian rupees for these transactions. Similarly, Chinese businesses might pay for Brazilian agricultural products using yuan. These direct settlements chip away at the dollar's role. They reduce the demand for dollars in these specific trade corridors. These shifts are not limited to commodities, they are occurring across various sectors. As countries build stronger bilateral economic ties, the incentive grows. They are incentivized to use their own currencies. This is especially true when political relations with the US are strained. The desire to avoid potential disruptions to dollar-based trade is strong. Companies are adapting to this new environment. They are exploring ways to manage transactions in multiple currencies. Financial institutions are also developing new services to support this trend. While the US dollar remains dominant globally, these examples are significant. They indicate a clear direction of travel. More and more international trade is likely to be conducted outside the dollar system. This trend is gaining momentum. It is being driven by both governments and businesses. Each transaction settled in local currencies is a small step, but collectively these steps contribute to a larger transformation. The global financial landscape is slowly but surely evolving. Section 8. Empowering nations, the promise of financial autonomy. The move towards de-dollarization offers significant benefits. This is particularly true for developing and emerging economies. One primary advantage is reduced exposure to US monetary policy. When a country relies heavily on the dollar, its economy is affected. Changes in US interest rates or the dollar's value have a direct impact. By using their own currencies more, nations can gain some insulation. They can better shield themselves from these external influences. This allows for more independent economic management. Another key benefit is the potential reduction in transaction costs. Conducting international trade in US dollars often involves fees. These include currency conversion charges and intermediary bank fees. When countries trade directly in their own currencies, these costs can be lower. This makes trade more affordable and efficient. For developing nations, even small savings can be important. Lower transaction costs can boost competitiveness. They can also encourage more businesses to engage in international trade. Using local currencies more extensively also promotes domestic financial markets. It increases the demand for the national currency. This can lead to deeper and more liquid financial markets within the country. Stronger domestic markets can better support local businesses. They can provide more options for savings and investment. This contributes to overall financial stability and development. It helps countries build more resilient economic structures. This is vital for long-term growth. Ultimately, de-dollarization initiatives can enhance economic sovereignty. They give nations greater policy flexibility. Countries can tailor their monetary and fiscal policies. They can address their specific domestic needs more effectively. This financial independence is crucial for fostering sustainable economic development. It allows countries to pursue their own development paths. They become less dependent on the economic conditions of a single foreign power. This shift empowers nations to take greater control of their economic futures. Section 9. A new financial horizon, the future beyond dollar centrality. The ongoing shifts in global currency use are profoundly important. The efforts towards de-dollarization signal a major change. They point towards the emergence of a more multipolar financial world. In this new landscape, the US dollar will likely not disappear. However, its unchallenged supremacy is clearly being contested. Other currencies, such as the yuan and potentially others, may play larger roles. This transition will not happen overnight. It will probably be a gradual process unfolding over many years. The implications of such a transformation are vast. Global trade patterns could be reshaped. Investment flows might be redirected. New financial corridors are being established between countries. These corridors will operate using alternative currencies and payment systems. This could lead to a more fragmented but potentially more balanced global economy. The reliance on a single dominant currency has its advantages, but it also carries systemic risks. A more diverse system might offer greater resilience. The United States will need to adapt to this changing environment. Its ability to exert financial influence might diminish. The exorbitant privilege of having the world's reserve currency could be eroded. This would have consequences for the US economy. It might affect its ability to finance its deficits. It could also impact the global perception of US economic leadership. The world is watching closely how these dynamics play out. International cooperation will be key to managing this transition smoothly. For the rest of the world, this evolution offers both opportunities and challenges. Developing nations may gain greater financial autonomy. They could reduce their vulnerabilities. However, a more complex currency system also requires new skills. It needs robust institutions to manage risks effectively. The journey towards a new global financial order is underway. It promises to be a defining feature of the 21st century economy. The world must prepare for this more diverse and dynamic currency landscape.